Today we're going to have a conversation about retirement savings fundamentals. Hi, I'm Debbie Oswald and I'm a principal with SVA Wealth Management. I work with physicians like yourself to achieve their financial goals. Let's get started on what we need to think about for retirement savings. First, you need to understand your cash flow. The sources of income that come into your bank account, the expenses that need to go out, and the commitments that you have every month, and to see if there's some capacity to save or if you can create that capacity. Once you understand your cash flow, the next step is to create your emergency reserve, and then we'll actually establish your savings habit. Let's take a minute on the emergency reserve. Getting started with this, you want to think about establishing 3 to 6 months of your fixed expenses or known expenses that you have every month and set that aside in a separate account. Something that's easily accessible, might be a savings account or a money market account. Oftentimes it's good to think about targeting 3-month savings and how do you get yourself there, because that can serve as a bridge to disability should you need it. Once you've built this emergency reserve, we want to begin balancing your savings for retirement as well as paying down debt. So let's take a look at getting started with retirement savings. One of the key things is starting early. The reason we want to start early is really to take advantage of compounding returns over time, where ultimately you could actually save less and achieve more. So let's take a look at an example. Here we have 2 people all targeting a retirement at age 65 with a 6% growth rate. Late starter starts at age 40 and saves $250 per pay period. The total savings is $75,000. Then early saver started at age 25 and saved half as much at $125 per month and saved a total of $60,000. The net result at age 65 is that early savers account is $75,000 larger than late starters, while contributing $15,000 less. This is the power of starting early. So let's talk about some terms that you might need to know when you're thinking about retirement plans. First of all, today we're going to talk about defined contribution plans. These are retirement plans offered by your employer. They come with some of the tax code section names, 403B, 401K, and 457. Another term that you'll want to know is employer match. Some employers or some plans offer a match on the dollars that you contribute. The key thing to remember here is this really is free money. If you contribute money, they will put a matching amount into your account, and you always want to capture these employer matches. Another term to know is maximum annual contribution limit. Each plan, whether it's a retirement plan through your employer or an IRA, there are maximum amounts that you can contribute each year. Those may not feel so critical at this point in your career, but later in your career will be very important as you'll tend to bump up against those limits. The other type of plan to think about are IRAs. There are traditional IRAs and Roth IRAs. At this point, we're going to focus more on the Roth IRA, and also knowing that if you're married, your spouse can also contribute to an IRA based on your earned income. So understanding those basic terms, let's take a look at how do we begin to accumulate our money for retirement. If you think of your accumulation as in 3 different buckets, throughout your career, you're going to want to create some dollars in each of these buckets. The first is the taxable bucket. This would be money that came through your paycheck, ended up in your bank account, and then you decided to invest it in a brokerage or investment account. Your contributions going in there are after tax, and along the way, as you have earnings that are realized, you're going to report those on your tax return and pay taxes along the way. The middle bucket is the tax-deferred bucket, and this is created through some of those employer plans that we were talking about, where you might put pre-tax dollars in this bucket. Oftentimes, this may become the largest bucket in your overall investment portfolio by the time you get to retirement. However, the third bucket is a very important bucket. It's sometimes the most difficult one to create during your career based on some of the rules and regulations. This is the tax-free bucket, or the Roth. This bucket, you put your money in on an after-tax basis and it grows tax-free for your entire lifetime. So when you take withdrawals from your Roth IRA account, you will not pay taxes at that point in time. So it's really important for us to think about how do we, throughout our careers, create that Roth bucket. So let's take an example here and look at what happens to your paycheck. A lot of numbers up here, but I'm going to focus just on a couple key numbers on how do you make an impact and contribute to a Roth account. So if you start with a resident that's making $60,000 or $5,000 a month, and look at the net pay shown in the top chart of no savings, then also pre-tax savings and Roth savings. Your take-home pay is the highest if you don't save. If you use the pre-tax, that's the next highest. And then the Roth savings is actually the lowest take-home pay because you're making that contribution after tax. However, remember that tax-free growth you're going to get. And shown down at the bottom, you can see that your Roth savings is only impacting your take-home pay by $40 a month relative to saving on a pre-tax basis. And that's simply because at this point in time in your career, you're probably at your lowest tax bracket. So let's take a minute and pause and think about what are the reasons we want to contribute to this Roth IRA. First of all, currently you probably are in that lowest tax bracket that you will see during your career, or one of the lowest. Also, as your income increases, more restrictions apply to how you can make Roth IRA contributions. Plus, you will find over time the limits on which you can get into the Roth bucket are more restrictive. Another key reason to start your Roth IRA is to get your 5-year clock started, as there is specific rules to achieve penalty-free and tax-free withdrawals on your Roth IRA. The last, and oftentimes not understood or thought about, is in several of the employer retirement plans, you can create a pool of under contributions, meaning that you weren't able to fully take advantage of those plans in your early years, and you may be eligible for special catch-ups later in career. So all the more reason that we want to step outside of the employer retirement plans to contribute to a Roth IRA and take advantage of all 4 of these opportunities. So let's talk about all these plans. How do you prioritize where you make your contributions? And we created a bit of a hierarchy here to help you. First and foremost, if there is an employer match, you want to capture that. The best way to do that is to prioritize the Roth contributions. And then if Roth is not available, use pre-tax contributions, but always get that company match that is, free money and the best return that you're going to find. The next step would be to contribute to a Roth IRA. So open an IRA on your own and get that done. You can also do this for your spouse, as we mentioned. And then ultimately, if you still have capacity in your cash flow, to go back and look at the employer retirement plans and continue contributing to either your 403B or 401k plan, and then also the 457 plan. There's specific reasons based on your goals that you might prioritize one of these employer plans over the others, but really recommend that you talk to an experienced financial advisor just to ask some questions and be sure that you're using your plans in the best way possible. So let's pause for a minute and think about what we learned today. First and foremost, we want to build that emergency reserve. We want to get started early and capture that employer match if there ever is one. Prioritize Roth contributions, and most importantly, get started and create that savings habit that will carry you through your career. At SVA Financial Group, we've worked specifically with the physician community for over 25 years. We offer investment portfolios, financial planning, and coordinated tax strategies. Our professionals understand the distinct financial needs of physicians, and we have a collaborative process in which we work together. We have a broad team of advisors ready to assist and support you, so please reach out and let us know how we can help.